Hello and welcome to PQ Prime. You're joining us on this special broadcast where we're joined by Mr. Kapish Jain, the Group CFO of IIFL Finance. Ms. Jain, firstly, welcome to this conversation. You've just announced your quarterly results for the June quarter last evening, and I wanted to get a sense from you as to what these numbers are looking like. Let me ask you the first question with regard to the net profit. Now, there I saw a peculiar specification about minority interest. Without adding or removing that minority interest, your net profit grew about 43%. But adjusting for that, it's about 29%. So I just wanted to get a sense as to how this stacks up and what this means actually.
In year 23, we got a new investor which came on board, ADIA, and ADIA holds around 20% stake in a housing finance company. So the minority stake is something that we need to adjust for the holding that is not held by the holding company and it's held by another investor in a subsidiary. So that's the adjustment that you need to do on the overall profitability stack perspective. With that adjustment, the overall number comes down because that share you need to break in there as well. So
Fair enough. I want to touch upon the loan book side of the story now. So your assets under management, the total assets for IIFL Finance on a consolidated basis is about 68,178 odd crore. That's up about 29%. Now, if you look at the components of the book, your own lending book is up about 21%, but there's also a co-lending portion which is suddenly increased more than double. Of course, we are talking about two different bases. But just to get a sense as to what the loan book growth looked like for you, where are you seeing most of your growth coming from?
If you see this particular quarter, you will notice that the growth has been broad-based. The growth has been there in the range around 5 to 7% across all our businesses, be it gold, be it housing, be it microfinance, and the digital as well as the lower base. So unlike what you've seen in quarter four, where the microfinance grew by around 25%. So that gives us an understanding that the growth is fairly broad and the growth exists across all the product segments. We have been widespread and present across all the geographies. In fact, our geo presence is also fairly spread between east, west, north, south. That is helping us to taper the opportunities that are existing in the market. Therefore, we think that we've grown at a CAGR of around 23% in the last 5 years. We believe that in the retail core segment, we should be able to meet those requirements. Even the fiscal quarter one is suggesting a 5-6% growth, which again puts across this story that we should be able to get to that 25% growth in this particular fiscal.
Fair enough. Coming to the co-lending side, I wanted to get a sense from you. It's about 8,900, roughly 9,000 odd crore.
Yes.
The co-lending book. So, what has been your experience like as a NBFC working with some of the other larger lenders, banks mostly, I'm assuming? How has this co-lending sort of partnership played out for you?
Co-lending partnership has laid out fairly well. Around 67-68% of our book is priority sector assets. Bank has a requirement of 40% of their advances to be in priority sector. So that's one requirement of bank that we address through the co-lending model. Gold is a zero risk weight asset, which again, when it goes to a bank on a net margin perspective, it's a zero risk weight asset. So with the LTV level that we maintain, that again goes as a zero risk weight when we pass it on to the banks. Both these aspects are helping banks look into buying such asset. Over the years, we have done direct assignment transactions, which means in another manner we have full access to the bank, and these assets have performed very well, and there are numerous cycles of payments coming in and being paid back. That gives comfort to the bank that whatever assets that we have originated have been of good quality. That makes task a little easier and simpler. Co-lending again another version of direct assignment transactions, and having shown these past historic performance on direct assignment. We are able to do a good business of co-lending as well with the banks. And they are very widespread banks. If you see our presentations, we are working with private sector banks, we are working with public sector banks, and being able to then de-risk ourselves on our dependencies for particular minimum count of banks. We think that this will do well, that this is going to grow even further because there's enough and more demand existing. As long as you are able to take care of good service to the banks, with regard to MISs that they require, information that they require, the timeliness of your revert to any query that can come in, giving them the right information for any stress if it comes in the portfolio, more particularly what are you doing with regard to recovery and collection, what action that you're taking on that customer. That aspects of comfort also needs to be given, because 80% of that loan of that customer is now owned by the bank, and they have every right to know what we are doing on the recovery and everything. As long as you bring that clear transparency channel of communication, there's demand existing for us to grow in the co-lending space.
Do you retain all the assets that you co-originate? I mean, I know the ownership is with the banks, but in terms of managing, do you manage all of the assets that you co-originate?
Yes. Yeah. So whatever assets that we have acquired and passed on to a bank under co-lending, we also have a servicing agreement with these banks. And under the servicing arrangement, I then operate as a service agent, where with my operations and my branches, I am also responsible for servicing that customer for any of their requirement on a regular basis. For example, if they want a statement of accounts, I'm responsible. If they want a TDS certificate, I'm responsible to give it to them. So all those aspects I cater to. And then more particularly to make sure the regular collections are happening, you're following up with the customer in case there's any delay in the recovery and collection. All those are ownership for the company. And therefore, banks, what they find is that they don't need to incur a single money for operating expenses. And that's a good thing for them to look for when they source such businesses from us. So the entire service responsibilities are ours.
Okay, fair enough. I want to touch upon the asset quality side of the story. So now your book has grown. I mean, your own loan book has grown about 29%, 21%. I'm sorry, but I'm just curious to understand in terms of your asset quality, that has remained largely flat quarter on quarter, 1.84% overall gross NPA. Did you see any elevated slippages during the quarter, or is this business as usual?
No. So just like business growth, even on asset quality side, you will see largely a lot of finance companies have come out with very good numbers from quarter one from fiscal perspective. But then things really gets a little easy when you go into quarter one, and you might see some slippages coming as you move into subsequent quarters and more particularly quarter one. But we have made sure that our focus on recovery and collection doesn't ease it out. And we work very closely with people on the ground to make sure that the collection engine is working as robust and as swiftly as it was operating in quarter four. That is helping us in maintaining our asset quality to what it was in quarter four. Second aspect is the market is good. The environment is looking very conducive, and the customers' payment cycles and everything is fairly decent. That again makes sure that you have a good collection efficiency. Your part numbers are healthy, and that will eventually result into a good asset quality. So these are the various environment, both internal and external, which is helping us to keep and maintain a fairly healthy asset quality. Our endeavor would be to see how we can further improve, what are the various measures we can do to get ourselves even better, and that's a continuous process.
Okay. Relatively speaking, the digital loans portfolio has a slightly higher in terms of delinquencies. Of course, it's come down quarter on quarter also. But this 3.38%, is this nature of the business, the unsecured lending?
One important thing in any business, you need to make sure that you are right pricing your asset, which means that the yield at which you're operating should take care of concerns which can come with regard to asset quality.
Okay.
These are unsecured businesses. In unsecured businesses, you don't have any underlying security cover, and therefore there could be some delinquencies which can come in. But then, as long as you're having the right asset yield, your delinquencies can be addressed well. I would not say that this is an acceptable level of delinquencies in this portfolio. It has to come down. And given that we are still small in this segment, it doesn't really make too much of dent or the impact on the P&L.
Right.
But then it's extremely important that on a standalone basis, that business has to give you a good risk-reward return on the business that you're building. So we would believe that what you have seen as a trajectory that these asset quality has shown improvement. It should stable down and it should come down even further as you book more pristine quality asset portfolio. You take corrective measures in this journey for segments which have shown you concerns. What corrective measure can you do there? Would you need to increase your CIBIL levels? Do you need to take care of some of the negative aspects of the customer segments or industry in which they're operating, which is giving you more pain? Do you eliminate them? And that's something that we keep doing all the time. And that's why you've seen some improvement in the asset quality, and we believe that they should even improve further.
Okay, fair enough. I'm glad you brought up yield, because my question was regard to cost of borrowing. Actually, that has gone up, year on year about 44 basis points, quarter on quarter about 15 bips. I understand because obviously in the economy we are seeing elevated interest rates, but has that now sort of peaked in terms of where you are on cost of borrowing, or do you think more is in store?
Fed recently, just last week or a couple of days back, increased the rates, right?
Right.
In India, what we have been noticing is that the rate cycle has been stable and there have not been any upside on the rate side. But then you don't operate in isolation. You operate in a global environment where everything is connected. We still don't believe that the rate cycle will move any further in India. There have been a 250 basis point repo rate increase in the last 12 months, precisely from May 22 to May 23. There have been around 120, 130 basis point increase in the MCLR. All of this baking in, we have still only had a cost of borrowing going up around 45, 50 basis point, what you mentioned. Bulk of my borrowing is from bank borrowing. So bank borrowing, when the MCLRs go up, it doesn't make an impact. So that impact has come in quarter one, where you see a 15 basis point increase. But you'll also notice that we have paid back some of our high cost ECB borrowings, which has also brought our cost of borrowing down. So negative, so the benefit of that has enabled a 15 basis point increase in the overall cost of borrowing. The key is that you make sure that you maintain a decent spread. You can't always control the external market. If the rate suddenly goes up further, you would need to then live with a higher cost of borrowing. But then I just don't live with that. We have a dynamic treasury. We keep working what more we can do. But having said that, you should be in a position to pass on the rates to your customer, which we have been. Our spread was around 5.3 in fiscal 2018. In these 5-year journeys, in spite of all the changes that we saw from a liquidity to a COVID, we've still been able to pass on the rates to the customer and still maintain a decent asset quality from a recovery perspective to get a higher delta spread. So the key is spread, not just cost of borrowing. If the cost of borrowing goes up, you should be able to pass on the rates to the customer and be able to maintain the spread. And then work in a very dynamic manner to keep tapering down your cost of borrowing relative to the market. So I think each of them is something that we are very focused upon, and we should be able to maintain a decent spread with a more subdued cost of borrowing compared to the market.
Okay. Last couple of questions for you. One on the disbursement side of the story. So, most portfolios, most of the lending segments that you're in have shown a dip in Q1 in terms of disbursements. I'm assuming it's because Q1 is usually a weaker quarter for BFSI. But digital loans has been up different basis. But I'm curious to understand what the rest of the year looks like in terms of disbursements, specifically on the home loan and gold loan side of the story.
So like what you rightly mentioned, quarter one, quarter two, or maybe H1 quarter one is little more muted compared to subsequent quarters. All the momentum, all the action, the festive seasons, offers and schemes, both from competition as is all operating in quarter four. The customer's ability to even take new loans and is also more than in quarter four because of all the festive that we come in. Quarter one is muted, but still we have shown a decent overall disbursements. And more important is how are you growing? So our AUM has grown around 5-6%, which is in line to our outlook. Our outlook is around 25% growth. If you simply do a multiplication, it becomes 24% per annum. And therefore, we think that with the kind of disbursement that we have already gotten in quarter one, and with the kind of outlook that we have in the market, we should be able to maintain our overall growth of around 24-25% CAGR on a business side. Disbursements in the subsequent quarters should show further improvement, and because of the markets becoming more agile, and as the year passes, because of the seasonality piece, which also comes in from a festival perspective as well, all those will enable things to pick up compared to what you see in quarter one.
Right. Last question is with regard to comments made by another large non-bank lender in the system, who says that there is increased amount of leverage that they are seeing, and probably they are going to go slow a little bit on the personal loan side at least. And I want to get your view. Do you think that the dynamics in the business at this point in time warrant a more cautious stance?
So with regard to gold is a fairly secured asset. So in gold, you have a good protection of the underlying asset. So with that, you cover yourself well. Housing is also fairly secure because you have an underlying asset with regard to property, and that's one loan that somebody services first. In the order of priority, you'll always serve your housing loan EMI, and then you'll serve your any other secured asset loan EMI like a gold loan. And then you'll come to your personal loan because there you're not exposed, except for that your CIBIL will get impacted. People are getting super conscious on their CIBIL because they know that CIBIL will make sure that they get future flows of credit as well. and they are very conscious to service their liability. Having said that, loans like personal loans and unsecured loans are more fragile and more riskier, and therefore pricing is important. In a home loan, I price at 11%. In a personal loan, I'm pricing at 23, 24%. Enough and more margin to take care of your credit cost and credit risk that comes in. That doesn't mean that you allow your asset book to slip. But having said that, there's good cover. Even in microfinance, we are pricing at around 24%. That gives you enough cushion to cover your credit cost. Having said that, we do take corrective measures all the time, and personal loan portfolio or the unsecured portfolio is still very small for us, so it doesn't really make a huge difference or dent on the overall scheme of things. But then a corrective course action and improvements, looking into policies. Do I need to tighten my CIBIL criteria? Do I need to negate some of the sectors or professions or category which has been giving more stress? That's something that we keep looking all the time. And in an unsecured business, what is more important is your PAR number, which is 0+ or 1+ number. That's where the customer has already not been able to service his obligations. He's already gone from 0 to 1 in terms of paying his EMIs. The moment you see those numbers changing and moving up, you would clearly action yourself and you look into by geography. What we give out to the market is the overall pan-India number, but you have to look into geographies and see which are the segments which have a higher delinquencies or higher PAR numbers, which are the areas and geographies have those numbers, and you just keep yourself course correcting. Either you trim down more work on your policies, or you go slow on those markets. Today, if you see our numbers, our PAR numbers, for example, microfinance, which is the most fragile segment, is having a PAR of 4.5. That suggests a very comfortable level. MFIN, which is the body which throws out numbers across competition and everything together, has also been showing a very comforting number. So that all suggests that the environment is still decent and fine. But then you need to be completely glued to the market with your eyes and ears open and take action sooner to make your asset quality maintained to where they are today. So I won't say that market is over leveraged can be a generic statement. India is so widespread that there could be certain markets which are more dynamic, there are certain markets which are more acceptable. People's own philosophy and theories changes, and that decides where your leverages are across geographies.
All right. Thank you so much, Mr. Jain, for joining us on this conversation.
Pleasure is mine. Thank you.